as expected, not changing rates. It is a unanimous, decision by the MPC to leave the repo rate at 5.25%. The stance unchanged at neutral. But as far as the macro forecast is concerned, there have been some tweaks, although RBI refrained from giving out any forecast for the full FY27, either on GDP or CPI, on account of the revision, the revision that is expected with the new base series getting changed in the coming days. So as far as CPI is concerned, for the current year, there's been a 10 basis point upward revision. It was earlier 2%. Now it is 2.1%. And for the next 3 quarters, that is Q4 onwards, there has been an upward revision in the CPI numbers. So what was 2.9% for the fourth quarter is now seen at 3.2%. What was 3.9% for the first quarter of the next fiscal is now 4%. And what was 4% for the second quarter is now seen at 4.2%. On growth as well, as expected, RBI for FY26 has left it at the number that we got from the economic survey, and the first advance estimate, 7.4%, is the growth number for the full year. For FY27, we only have the first half numbers, and that is 6.9%, an upward revision from 6.7% below. And Q2 is seen as 7%, which is again an upward revision of 20 basis point. On liquidity, I think that is going to be the big disappointment. Not much said by the RBI governor, no mention of OMOs, only that they will continue to keep it comfortable with various measures as and when needed.
I think that some of the stuff, it's basically it's absolutely as we discussed earlier, nothing at all. And towards the end, there was a few announcements with regards to NBFCs, bank branches, etc., etc. Housing loan, there was something, etc.
For urban cooperative banks.
Urban cooperative banks. So I think it's banking and more kind of sort of that kind of policy in terms of look at the market reaction. Nothing. Yields have not moved. Markets have not moved. Bank Nifty is not moved. We have SBI's Ashwini Kumar Tewari with us. We also, of course, have our economists Kaushik Das and Upasna Bhardwaj. We also have Shobhit Mehrotra with us. Thank you all for joining us. Ashwini ji, if I can come to you to begin with, Prashant here. Highlights according to you, sir, from the policy.
So the rush at the end, as you rightly mentioned, is something we are still absorbing. Those were the highlights. There was no change in the policy as we expected. So therefore, the announcements on banking, which is customer protection, financial inclusion, the raising of the ceiling of the MSME collateral-free loans, and of course, we are expecting the final ECB guidelines. So quite a lot of announcements towards the end. And we haven't had time to go through all of them in the detail. We will wait for the more details to emerge. But I think the focus, both of the government through the budget and of the RBI, is to push growth. And you are aware of the budget announcement of the Committee on Banking. So we will wait for those terms of reference. And I think there's a lot of focus on growth, having sorted out the FTA and the US-India trade deal. The focus comes back to growth, and banks have to play an important role in that.
Tewari, just from what you've heard, and you said you will need to absorb it in terms of the exact specifics, but doesn't look, this is all, of course, aimed at more liquidity transmission and more credit in the system, as you said, but doesn't seem like an outsized impact in that sense, right, for any segment of the be it NBFCs or banks, right?
Yeah, no outsized impact. But I think the most important and the best policies, which is slightly boring, which is continues on a regular path, which gives consistency to the economic outlook and to the markets, not having too many changes. So I think in that respect, it's a very stable and a consistent policy. And whatever changes are announced, they are to make things better for customers, for banks, for all the market players. The corporate bond derivative is also a very important announcement, which we have to see the final guidelines and the total returns. So all of them are important announcements, but nothing outsized, nothing very, very earth-shaking, as you say. And we don't expect that to happen also.
But I'm wondering, Mr. Tewari, why you're not sounding a little more disappointed, given that nothing was announced on liquidity and with, deposit growth, lagging loan growth, the transmission, isn't that going to be a problem? And the second question was also on some of the measures announced, but first, if we could get your reaction on that.
So as the governor very clearly said that they will be dynamic, and as and when needed, they will take liquidity measures. They have done OMO yesterday itself, and they will do in future also as required. He said that as the government balances move, as the payments move, they will take further steps. So we don't expect full announcements all in this policy. As things evolve, they will take steps as required. And I'm sure that liquidity will be on their radar. This is the last quarter. where a lot of taxes have to be paid. Liquidity is generally under constraint, and therefore I think measures will be announced as and when needed, not necessary that they should be done today itself.
Mrs. Tewari, just one more quick question on, one of the non-policy measures was the fact that the collateral-free loan to MSMEs, the limit for that is proposed to be increased from 10 lakhs currently to 20 lakhs. What kind of, additional credit do you think that could unlock for a bank like SBI?
So I think the collateral-free loans anyways, with the CG to SME having come in and that ceiling has gone up tremendously, so that there was no dearth of offering collateral-free loans to MSMEs. What changes is that up to 20 lakhs perhaps will not require the cover as well. And therefore, to that extent, the fee which is paid by the customers, MSME customers, will not require to be paid. So for smaller customers, I think this is a good step in terms of being more viable loans, which they will get. And this will unlock a little bit. I don't think it is going to do a lot, but it will make the credit more affordable for the MSMEs, the smaller SMEs. And therefore, to that extent, we feel that there could be some more pickup in this.
Upasna, your quick read of the policy and what you got in terms of, the next steps. Are we in for an extended pause with the kind of upward revision that we've seen to the CPI base? Of course, a lot of it is going to be, affected by the fact that the base year changes, we'll get new numbers. But what is your read? We're in for a long pause from here?
Yes, at the moment, if we read the numbers, there is a slight upward revision to the inflation reading, and there is also an upward revision to GDP numbers. In this kind of a context, of course, like you said, we will have to wait for the next GDP and the CPI readings, which are revised, whichever way. But for now, it appears that RBI's focus will largely be on liquidity, and more or less we are done with the rate cutting cycle. We will be seeing a prolonged pause from now, unless there is a dramatic change in the trajectory suggested by the new CDs.
Okay, and Kaushik, on liquidity, you were factoring in about 2 trillion is in the first quarter. Perhaps now that'll come outside of the policy. You still hold that view, and anything else that stood out for you, Kaushik?
Yeah, so the first thing is I think RBI has done the right thing to not kind of give the FY27 GDP and inflation forecast for the whole year, given that we'll get a new series of GDP and CPI. And, they have done the right thing to hold rates. And what they have also shown, and what the governor mentioned, that, yields have hardened in India, partly also a reflection of the global interest rate cycle also having turned and interest rates having gone up. So it's not something idiosyncratic to India or we should panic. And therefore, if you've seen India 10-year bond yields, I think have gone up from 665 to 670. But I don't think RBI is too much worried on that. And that is a good way of communicating to the market that, all these yields are also a reflection of market sentiments, and RBI will not come and try to, reduce it too much by doing certain, liquidity operations. Having said that, I think, as Mr. Tewari mentioned, that March we have advanced tax outflows and all these things which will come into play. And therefore, I think there will be a need for more liquidity infusion. But at this stage, what we discussed, RBI already in the system, we have 5 lakh crore, surplus liquidity. What is more important for markets over the next 2 weeks is to see whether RBI is sucking out that liquidity or not. If RBI doesn't suck out that liquidity through what we call VRRR, that itself will be very positive for the market, because short-term rates will then remain closer to the SDF rate between 5.25 instead of staying above 5.25. So if you remember in June, when RBI cut the interest rates by 50 basis points, after a couple of weeks, it started doing VRRR to withdraw some bit of excess liquidity. And that led to fear about transmission, not happening and all that. So we need to wait and see whether RBI sucks out that liquidity or not, which is there. And if it doesn't happen, that itself is positive. And over a period of time, I think, it is a question of timing. RBI will have to announce more OMOs because of the demand-supply dynamic of the budget as well. But overall, I think it's been an excellent announcement, and RBI has shown kind of stability in its announcement, and markets will move on from here. The reason I said the risk, to growth being revised up, the risk was the bond market, not equity markets. As you've seen, these have hardened with both inflation and growth forecast being revised high.
Yes, in fact, let's pull up the 10-year bond yield. It was 6.65, at the start of the policy. It's gone up by about 4 basis points. Now you have it at 6.69 or so. If you could have, the 10-year yield up for you. There's a little bit of a hardening, because we didn't really hear much from RBI on specific liquidity, injecting measures. I think that was a tad bit of a disappointment. But Mr. Tewari, good for you for now. At least no rate cuts have come in. So margins will remain protected in the near term.
Yeah, margins will remain protected, but I would take this opportunity to bring out some other measures announced, which I could not say in the first instance.
Yeah.
One which very important announcement was on allowing banks to lend to REITs. Now, this is a 2 lakh crore market, but growing at 25% and expected to reach 25 billion by 2030. So I think this is a very, very important announcement. We will wait for the guardrails he mentioned. But I think along with InvITs, REITs, these are the ways to go to unlock capital from productive sectors like real estate. So this is a very, very important announcement. Also, I think one other thing which RBI has been focusing on, but it needs to be continued, is the fact that we need to protect customers better from digital frauds. And therefore, this announcement of small value transaction frauds, compensation to be paid, senior citizens to be protected. So we'll wait for those details as they come in. But I think those two are, again, very, very important announcements from a banking landscape perspective.
Mm-hmm. Okay.
I just want to highlight, you pointed out yields, right? So I just checked out, Ritu, the Nifty Bank. So the reaction actually started, I think, around the same time. 10:30 onwards, 10:30, the Nifty Bank was at 60,000. It's basically come off about almost 300 points now on the Nifty Bank. I mean, I think an intraday will tell you that story. So maybe at the margin, there was some expectation. Markets are always hopeful. And it's their job to expect. Policymakers must do what they think is right. So there's a little bit of a drop-off which has happened. I mean, some 270, 280 points, and that is 10:30 onwards, because I guess the markets were waiting till the last minute to see if there is something. But obviously, it's been a steady kind of sort of holding pattern kind of policy. Ritu.
Well, we'll have to see. It's not good news. I mean, yields hardening is not good news for the economy, not good news for the banking system. Could be a bit of a treasury hit we might see in this quarter because of what's been happening. But Shobhit, thanks very much for patiently waiting by. Give us your quick takeaways. Any additional information you've been able to, get out from the statement that we've heard so far, and going ahead, what is your sense? Is there any other, is there a chance of any further rate cuts, or are we in for a pause?
Well, I think the policy was on expected lines. It's a status quo policy. There were some expectations on liquidity front that RBI may announce some relaxation on LCR or some other measures to improve the liquidity for banks. But I think the RBI is drawing comfort from growth resilience, and they are quite confident that private consumption would sustain the momentum which has been seen. Nothing much needs to be done. So I think post this policy, market would get around to the view that further cuts are far away, if any. It's going to be a very long pause with only intervention coming from RBI in the form of providing liquidity. So medium term or in the coming fiscal, market has to contend with a very large borrowing program, over 17 lakhs crores of gross borrowing number. So it is going to be tough. I think once the SDL borrowing number also comes out for the fiscal 27, market would, find it difficult to absorb that kind of a supply of both GSEC and SDL, which it has to contend with. So, short to medium term, I think bond yields will continue to remain under pressure unless the global backdrop completely changes and we see, growth slowing down globally and, risk of environment or risk of sentiment, spreading globally and coming to India. So only in that case, perhaps we'll find some degree of, comfort for bond yields. But otherwise, bond yields are seemingly heading higher, from where we are today because of the large pressure of supply, which is likely to hit in the coming year.
Yeah, could be almost 30 trillion if you account for the, state SDLs as well. But Mr. Tewari, quickly, I know you have to leave. The governor is going to be addressing the media shortly. I'm wondering if banks like you had any clarifications that we could put forward to the RBI. Any questions you would have of the governor or anything you'd be keenly watching out for?
It's too short a time to actually ask any clarification today itself. And you all have been very good spokespersons for all of us banks. So I think you already have questions you will ask on liquidity and other stuff. Nothing at the moment. I think it's, as everybody's mentioned, it's a steady policy. The only thing I would say, I mean, I know the yield should be lower, but I think as the large borrowing program comes into play, the focus actually is more on the capex side. So as that starts to happen, the growth will be further strengthened, and into that sense, it will be a good higher borrowing, if I can say, I could call it that. So in that sense, overall, it will settle down. Nothing more at this point of time. We will wait for all the announcements and the details which will come out in due course.
All right, Mr. Tewari, thank you very much for joining in with that. We'll let you, leave us at the moment and hope to catch up again as we get more details from this policy. We'll slip into a short break, but don't go anywhere. We're back to continue to analyze this policy and also take a look at the markets when we return. Welcome back. We're continuing our coverage of the RBI monetary policy. For viewers that have just tuned in, the Reserve Bank of India has left the repo rate unchanged at 5.25%, left the stance unchanged at neutral. But there's been a bunch of revisions on the macro forecast and, some measures for banks and NBFCs to ease the credit flow in the economy. We still have Upasna Bhardwaj, Chief Economist at Kotak Mahindra Bank. And, we also have Kaushik Das, Chief Economist at Deutsche Bank with us. Upasna, in the few minutes of time that you've had in the break, any additional takeaways that have come out for you from the read-through of the governor's statement?
I think, Ritu, broadly, I would say that, much of what the governor has said has been in line with expectation and a very balanced one. While, yes, we could have seen unchanged inflation and GDP numbers. That is the only change that has happened. Otherwise, I would say at the moment, whatever the guidance that the governor has provided is a fairly balanced one. We should not read too much into it. But overall, I think the broader theme going ahead will be focused on liquidity and how the frictional and the durable liquidity will have to be managed going ahead, how the sentiments will have to be managed going ahead, maybe through verbal intervention as well if required. But otherwise, I don't really see much of a change. I think I just want to point out it was a consensus, unanimous view on a pause. So I think that also points towards the fact that most of the members do believe that they are done with the rate cutting cycle and we will be seeing a prolonged pause. So I think these are aspects to be kept in mind. For us, what we look at is now that the US-India trade deal has tentatively been announced, let's put it like that, at least there is some kind of headwinds which have faded off. And if the FPI flows were to begin, then probably the need for durable liquidity, at least into this year, will reduce significantly. So I think at this point, we don't really see too much room for OMO or additional buy-sell swaps or so in this quarter. Going ahead into next year, of course, going by a simple structural requirement of liquidity, there will be need for additional OMOs or liquidity measures, but we don't really see that to the magnitude that we've seen this year. I think if things stabilize and flows stabilize, then the balance of payment will start looking slightly better into next year, and hence the need for durable liquidity infusion will be limited. But at the same time, as Kaushik was mentioning earlier, I think at this point, markets were more worried that if RBI was to introduce a VRRR, that could have acted as an adverse factor here. And the good thing is that very prudently, they have refrained from announcing anything on the VRRR front. I think they should delay this for some more time so that they don't unnecessarily unnerve the market. And that's how I would put across today's policy.
Well, the RBI certainly seems to be in the favor of keeping these liquidity announcements completely outside of the policy, manage it day to day. But Upasna, very quickly, before I go to Kaushik, RBI's number for inflation and GDP is 2.1% inflation for this year, an average of about 4.1% for the first half of next year. And on GDP, 7.4% this year, 6.95% average for the first half of next year. What are your internal estimates and, how do you gauge what RBI has given us?
Ritu, I think it's broadly in line. Just the only trouble is that we will be seeing a shift in these numbers in a week's time for inflation particularly. But actually for H1, we are at 4.1% inflation, which is broadly in line with RBI. I mean, a 10 basis here and there for each quarter. But broadly, we are at 4.1%. So I don't think there's much difference there. Maybe on the GDP side, we are a little on the softer side. We do believe that there could be a 20 basis downside to the GDP numbers in H1. Our full year numbers are at 6.5% for now. But again, as I said, we'll have to wait for the new series to really finalize these numbers.
Okay, Kaushik, you have the last word. What are your GDP and CPI numbers, compared to what RBI has announced? And any final thoughts? Anything you'd want clarity on from the governor when the press conference starts?
Yeah, so Ritu, a couple of things. One is, I think this policy is kind of indicating the forecast and everything that the rate cut cycle is behind us. I don't know why people are expecting rate cuts. On one hand, you're saying growth will be above 7%. If you see the chief economic advisor saying growth will be close to 7.4. And then you're saying that from April, June itself, inflation would be at 4% and then going above 4% mark in July, September. And when the October, December number forecast comes, you'll see inflation would be above 4.5%. So you're talking about an economy which is continuing to grow at 7% plus, with inflation now going to go above 4%. There's no question of giving any rate cuts. The maximum that RBI will do is basically ensure that the transmission of the 125 basis points rate cuts of last year, that continues into the market to the extent possible. But beyond that, market is telling us that the next rate action, whenever it is, maybe 2027 is when I have a rate hike from RBI in April. The next move is a rate hike and not a rate cut. So that's the first thing to remember.
Yes.
Second, on liquidity, what you can ask and what will be more interesting for the market is that currently, as I told you, we have durable liquidity of about 5 trillion INR, which is much in excess of 1% of NDTL. Whether RBI will look to kind of reduce some part of that liquidity through VRRR. If they don't use that itself is a very positive kind of sentiment for the market, because the short-term rates will be then anchored lower than the repo rate. But we have seen in the past, that when liquidity becomes too much in surplus, RBI has used this VRRR to reduce some liquidity because they have a neutral stance as well, so they can do that. But if they don't do it this time, that will be very good for transfer. They have used the word for the first time. I think, they normally use proactive management of liquidity. Now they have used the word preemptive. RBI will remain preemptive with liquidity management.
Correct. Yeah.
Does it mean that they'll give more, or does it mean that they will suck out liquidity when it is too much of surplus? That is what you need to clarify when you ask the governor during the press conference.
Sure, Kaushik. All right, Kaushik and Upasna, thanks very much for joining in with your thoughts. That is as far as the Reserve Bank of India policy is concerned. No change on rates. That's at 5.25%. No change on stance. That remains at neutral. A whole bunch of revisions to the macro forecast. The CPI for this year is upped from 2 to 2.1%. And for this first half of the next year, again, a bit of an upward revision coming in from RBI. On the GDP front, again, this year's forecast left at 7.4%, and for next year, it's been upped to an average of about 6.95%. That's where we're at as far as RBI is concerned. A bunch of measures for NBFCs and banks as well that we'll continue to analyze for the day. But for now, we'll wrap up this special coverage on the monetary policy. Trading Hour will take all the action forward.